In this video, we are going to discuss few MCQs on accounts receivables for CMA US Part 1. First question. The allowance method for estimating credit loss expense. Credit loss expense is nothing but bad debt expense. The allowance method for estimating credit loss expense is required by generally accepted accounting principles in preference to direct write-off method because. First, let's understand the question. There are two methods available for estimating credit loss expense. The first one is allowance method and the second one is direct write-off method. The question clearly says the allowance method for estimating credit loss expense is required by generally accepted accounting principles in preference to direct write-off method. What does it mean? As per generally accepted accounting principles, allowance method should be used for estimating credit loss expense rather than direct write-off method. Why? Because that is what we need to identify with the available options. So the question says, generally accepted accounting principles requires the companies to use allowance method for estimating credit loss expense. In what way allowance method is superior to direct write-off method? So that is what we have to identify with the available options. Now, first let's understand how bad debts are recorded under direct write-off method and how bad debts are recorded under allowance method. For example, let's say in year 1 you have made a sales of, let's say, 1 lakh rupees. So in year 1 you would have recognized this revenue in your P&L account. We are talking about direct write-off method. Okay. In direct write-off method, how bad debt expenses are recognized. That is what we are discussing. Let's say in year 1 you have made a sales of 1 lakh rupees. You have recognized this revenue. So let's say in year 2, a customer who purchased goods from you did not pay the money. He went bankrupt. So there is a bad debt of, let's say, he purchased goods worth of rupees 10,000. Now he is not going to pay this 10,000 rupees because he has gone bankrupt. So in the first year, what is the journal entry that you would have passed for recognizing this revenue? You would have debited cash because cash is coming in. Sorry, you would have debited accounts receivable. Sorry, because it is a credit sales. So we would have debited accounts receivables and we would have credited sales. So revenue is recognized in the first year. In the second year, the customer did not pay the money. So there is a bad debt of 10,000 rupees. Bad debt expense of 10,000 rupees is there. So in the second year, what you will do is you will debit bad debt expense to your P&L 10,000 and you will credit your accounts receivable by 10,000. So in direct write-off method, you will wait for the customers to go bankrupt, which means you will recognize the expense only when the customers did not pay the money. Right? So in the second year only the customer is not paying the money. So in second year only you are recognizing this expense of 10,000 rupees. So this is how direct write-off method works. Now what is the problem with this direct write-off method? The problem is the revenue and expenses are not matching. Which means in first year you have recognized the revenue. Correct? But you are recognizing the bad debt expense in the second year, which is against the matching concept of accounting. Matching concept of accounting says the revenue and expenses should be matched. Your revenue is recognized in the first year, but bad debt expenses are recognized in the second year. So this is the reason why direct write-off method is not allowed under generally accepted accounting principles, because there is a mismatch between the revenue and the expense. Now how will it work under allowance method? How we are going to recognize bad debt expense under allowance method? Let's see. For example, let's say in year 1 you have sold goods worth of 1 lakh rupees on a credit basis. You would have debited your accounts receivable and you would have credited sales. So revenue is recognized in year 1. So let's see how it works under allowance method. So in allowance method, what you will do is, based on your past experiences, you will expect some percentage of your customers will not pay the money. Right? For example, let's say you are expecting that 10% of your sales will be credit loss or bad debt. So now what you will do? Your total credit sales is 1 lakh rupees, on which you are expecting 10% will not be recovered. So in the first year itself, you will record the journal entry, debit bad debt expense, or you will debit bad debt expense to P&L account. So debit bad debt expense, and you will credit provision for doubtful debts. So you will credit something called provision for doubtful debts, 10,000 rupees, 10,000 rupees. So this provision for doubtful debts is a contra asset account, which means it will be subtracted from the receivables balance in the balance sheet. So you will credit provision for doubtful debts and you will debit bad debt expense under allowance method. So now what is happening? Revenue is also recognized in the first year. Expense is also recognized in the first year. So revenue and expenses are matching, right? Now let's say this is your expectation. You are expecting that 10,000 rupees of customers will not pay the money. Now for example, let's say next year, that is year 2, actually customers who purchased 8,000 rupees of goods from you did not pay the money, right? Actual bad debt is 8,000. Your expectation is 10,000, but actual bad debt is 8,000 rupees. So now what you will do? You already credited provision for doubtful debts. You created a provision for 10,000 rupees. Now that provision will reduce. Why? Because you expected 10,000 rupees of customers will not pay. Now actually a customer who purchased goods worth of 8,000 did not pay. So to write off the bad debt expense, you will debit provision for doubtful debts, 8,000 rupees. Then you will credit accounts receivable, 8,000 rupees. Now you had a provision of 10,000 rupees. Out of the 10,000 rupees, 8,000 is gone. So now your remaining provision is only 2,000 rupees. So in case of allowance for doubtful debts, in case of allowance method, the advantages, or why allowance method is accepted under, or why allowance method is required by generally accepted accounting principle, is because it matches your revenue with your expenses. In first year, if you are recording your revenue, then in the first year itself you will record your expense as well. Whereas in case of direct write-off method, there is a mismatch between revenue and the expense. In one period you will recognize revenue, and in the subsequent periods you will recognize the expense. So which is against the matching concept of accounting. So why allowance method is required by generally accepted accounting principles? Because it achieves a proper matching of expenses and revenues. So option C is the right answer. So now let's look at second question. A company had the following account balances at 31st December. Accounts receivable balances 9 lakh rupees. Allowance for credit losses before any provision for credit loss expense, it is 16,000. What they are saying by they are saying that before any provision for credit loss expense. What does it mean? That we will discuss. So allowance for credit losses 16,000. Now one more important thing, see, this allowance for credit loss is there. No, this is nothing but the provision for doubtful debts. The other name for provision for doubtful debts is nothing but allowance for credit losses. Okay, credit sales for the year, it is 17,50,000. The company is considering the following methods of estimating credit loss expense for the year. First option is they can estimate their credit loss expense as a percentage of sales, that is based on credit sales 2%, or they can estimate their credit loss expense as a percentage of accounts receivable. Based on accounts receivable, it is 5%. What amount should the company charge to credit loss expense under each method? So first, let's say the company is planning to estimate its credit loss expense as a percentage of credit sales. So what is the total credit sales of the company? 17,50,000. So during the year, the company made sales worth of 17,50,000 rupees. Out of this 17,50,000 rupees, the company is expecting that 2% of the customers will not pay. So 2% of the 17,50,000 will be the bad debt for the company. So what is 2% of 17,50,000? So when we take 2% of 17,50,000, we get 35,000 rupees. So the journal entry will be, what we have to debit? We have to debit bad debt expense. So this bad debt expense will go to P&L. So bad debt expense account debit 35,000. And what we have to credit? We have to credit provision for doubtful debts 35,000. So as a percentage of sales, as percentage of credit sales, the bad debt expense for the year should be 35,000. So either option C or option D has to be the right answer. So 35,000 is the amount of bad debt expense that we will recognize if we are calculating credit loss as a percentage of sales. Now what will happen? See, we have 35,000 in the we have 16,000 already in the provision for doubtful debts balance. Right, we have already 16,000. On top of this 16,000, this 35,000 will be added to it. So what will be the ending balance? So already we have 16,000 rupees. On top of this 16,000, we are expecting another 35,000 rupees of customers will not pay. So 35 plus 16, we will get 51,000. So this 51,000 given in option A and option B are closing balances. But what is the requirement of the question? Requirement is to calculate credit loss expense. They are not asking us to calculate the closing balance. Suppose if they are asking us to calculate the closing balance, then either option A or B will be the right answer. Since they are asking us to calculate credit loss expense, in that case, either option C or D has to be the right answer, because to the P&L, we will debit only 35,000. I hope it is clear. Now let's see what is the amount of bad debt expense that will be. Let's see what is the amount of bad debt expense that will be recorded if the company is calculating, or if the company is estimating its credit loss expense based on accounts receivable. What is the total accounts receivable of the company? It is 9 lakh rupees. So out of this 9 lakh rupees of accounts receivable, the company is expecting that 5% of them will not pay. So when we take 5% of 9 lakh, we get 45,000. So we are expecting that 45,000 rupees of customers will not pay. But what is important to understand is, listen, we have option C where 35,000 and 45,000. But option C is not the right answer. Why? Because the requirement of the question is to calculate what amount should the company charge as credit loss expense under each method. This 45,000 is not the credit loss expense. This 45,000 is calculated as a percentage of accounts receivable. Accounts receivable is an asset, right? So what does this 45,000 mean? So when you are applying the percentage on asset, you will get a figure that is on a particular point of time. What does it mean? It means that accounts receivable as on 31st December is given. 9 lakh rupees is the value of accounts receivable as on 31st December. On this particular date, this is the value of the asset. Now we are applying 5% on 9 lakh rupees. We are getting 45,000. So this 45,000 rupees is not the credit loss expense, but it is the closing balance of the provision for doubtful debts. What does it mean? It means that at the end of the year, that is on 31st December, the company should have 45,000 rupees of provision for doubtful debts in their balance sheet. The company should have a total provision of 45,000. But how many rupees they are already having? They are already having only 16,000. So totally they need 45,000 as the closing balance. Already the company has 16,000. So what is the remaining? What is the top up the company should do? Already they have 16,000. But they should reach a balance of 45,000. So how much should be added? So 45 minus 16, we get 29,000. So 29,000 rupees should be added to the provision for doubtful debts, so that the closing balance become 45,000 at the end of the year. So what is important to understand is, you need to check whether the credit loss is estimated as a percentage of sales or as a percentage of receivables. If it is estimated as a percentage of sales, here 2% of 17,50,000, so that 35,000 is there, no? So the total 35,000 will go to P&L. Why? Because the already sales is an income statement figure. So this 35,000 will directly go to income statement as an expense, right? So already we have 16,000. On top of that, we will add another 35,000. So closing balance will become 51,000. But if you are estimating credit loss expense as a percentage of accounts receivables, then you will apply this 5% on 9 lakh rupees. The figure that you are getting, no, here we are getting 45,000. This 45,000 is not the expense that we should recognize. This 45,000 is the balance at the end of the year. Balance on which account? The balance that we should have on provision for doubtful debts. So 45,000 should be the closing balance on provision for doubtful debts on 31st December 2000 whatever the year. So if the company should have 45,000 rupees as closing balance and they already have 16,000 rupees, then by how many rupees the provision for doubtful debts account should be increased? It should be increased by 29,000. Now what will be the journal entry? The company should debit bad debt expense. So bad debt expense will go to P&L. So to P&L we should debit only 29,000 and we should credit provision for doubtful debts by 29,000. A credit to provision for doubtful debts means it is increasing, right? As expense increases, we will debit it. And provision for doubtful debts, it is a contra asset account. So provision for doubtful debts should increase by 29,000 and to the P&L we should debit 29,000. So option D is the right answer. Suppose if they are asking us to calculate what will be the closing balance under each of the methods, the closing balance under percentage of credit sales will be 51,000 and closing balance under percentage of accounts receivables will be 45,000. If they are asking us to calculate closing balance, then option A will be the right answer. Since they are asking us to calculate the expense that we will debit to the P&L account, then option D is the right answer. So then we have fact pattern for question number 3 and 4, which means based on the facts given from here till here, we have to answer question number 3 and question number 4. Madison Corporation uses the current expected credit loss model. What is this current expected credit loss model? It is nothing but the allowance method. The other name for allowance method is current expected credit loss model. Madison Corporation uses the current expected credit loss model to value its accounts receivable, and it is making the annual adjustment at fiscal year end 30th November. So the year end is 30th November. Credit losses are estimated based on all available relevant information, including past experience, current conditions, reasonable forecasts, qualitative factors and quantitative factors. So basically what they are saying is, we are arriving at this percentage, no, 2%, 5%. How did we arrive at these percentages? It is based on past experience, current condition, reasonable forecast, qualitative factors, quantitative factors. So by taking all these factors into consideration, we are arriving at this percentages. The total sales for the year were 18 lakh, all of which were credit transactions. So the total sales is the 100% sales is on credit. Madison has determined that Norris Corporation accounts receivable balance. Norris Corporation is a customer of Madison. So Madison is the company and their customer is Norris Corporation. Madison has determined that Norris Corporation accounts receivable balance of 10,000 is a loss and will write off this account before year-end adjustments are made. So what they are saying is, this 10,000 is a bad debt loss, which means this is not an estimate. Madison has determined that Norris Corporation is not going to pay this 10,000 rupees. So it is a complete loss. They cannot recover this 10,000 rupees from Norris Corporation and will write off this account before year-end adjustments are made. What does it mean? Listen, what they are trying to say is, in provision for doubtful debts, already we will have some balance, right? For example, I am not sure how many rupees we have, but I think we have the numbers here. Okay, so already in the allowance for credit loss or provision for doubtful debts, we have some 16,500 rupees, right? How many rupees of customers is not going to pay? 10,000. How many rupees you are expecting? You are expecting that 16,500 rupees of customers will not pay. but actually a customer, actually Norris Corporation, one of your customers, worth of 10,000 rupees did not pay the money, right? So what is the journal entry that you will pass now? You will debit provision for doubtful debts 10,000 and you will credit accounts receivable 10,000. This is the journal entry for write-off, right? Now you had 16,500 balance. Out of that, 10,000 is gone. So what is the remaining you have? Remaining you have is 6,500. Now what they are saying is these write-off is done before year-end adjustments, which means before increasing the value of the provision for doubtful debts. This write-off is done before increasing the value of the provision for doubtful debts. Means, for example, here you can see Madison valuation indicates that 1.5% of credit sales will be credit losses. So what we will do for here net credit sales is some amount, X amount. So on X amount you will apply this 1.5%, right? And you will get, for example, let's say you are going to get 1.5 by 100. For example, let's say you are getting 22,500. So now what you will do, already you have 6,500. On top of the 6,500, you will increase this 22,500. So this increase of 22,500 is done after the write-off. Even if you are not understanding at this point, I will explain this point again while solving the questions. Listed below are Madison accounts balance at 30th November prior to any adjustments and the 10,000 rupees write-off. So before writing off, we have a credit sale of 18 lakh, which is already given in the question, and accounts receivable balance is 7,50,000. Sales discount is 1,25,000. Allowance for credit loss is 16,500. Sales return is 1,75,000. Credit loss expense is 0. Madison's evaluation indicates that 1.5% of net credit sales will be credit losses. So what they are saying is, listen, what is the available balance in the provision for doubtful debts account? It is 16,500. So we have 16,500 rupees as a closing balance. This balance is before writing of this 10,000 rupees. It is mentioned. Before making any adjustments and 10,000 write-off, we have 16,500. Now what we will do is, Madison's evaluation indicates that 1.5% of credit sales will be credit losses, right? What is the net credit sales of Madison? Is it 18 lakh? No, this 18 lakh is the total sales. But out of this 18 lakh rupees, we gave a discount of 1,25,000. And there is a sales return of 1,75,000, right? So what is the net credit sales? 18 lakh minus 1,25,000 minus 1,75,000. We get how much? 15 lakh as the net credit sales. On this net credit sales, we are expecting that 1.5% as a bad debt. So how much do we get? 1.5% of 15 lakh, we get 22,500 rupees, right? So this 22,500 rupees should be added to this 16,500, right? But the question clearly says this 10,000 rupees is a loss and we will write off this account before year-end adjustments are made. What is the year-end adjustment? The year-end adjustment is the provision for doubtful debts should increase by 22,500. But before adding this 22,500 to the provision for doubtful debts, this 10,000 will be written off. So what is the balance we have? 6,500. From the 6,500, we will increase this 22,500. That is what they are saying by before making any year-end adjustments, this 10,000 is written off. The meaning is, before adding 22,500 to 16,500, we will subtract this 10,000. That is the meaning, right? Now, the requirement of the question is, we have two requirements, third and fourth. The third question, the entry to write off Norris Corporation accounts receivable balance of 10,000 will. So here, what is the entry we have made? To write off the accounts receivable of Norris Corporation, what is the entry we are making? We are debiting provision for doubtful debts and then we are crediting accounts receivable by 10,000 rupees. What is going to be the effect of this entry in the books of Madison Corporation? That is what they are asking. So here we are debiting provision for doubtful debts and we are crediting accounts receivable, right? What is the effect of this entry? let's look at option B first. Increase total assets and decrease net income. We are crediting accounts receivable. Correct? If you are crediting an asset, then asset should decrease. So obviously it will not increase the total asset. So option B cannot be right. And it says decrease net income. Here provision for doubtful debt is a contra asset account. Accounts receivable is an asset account. So there is no involvement of net income here. It is going to affect only the asset side of the balance sheet. The P&L statement is not going to be affected. So this is not. So this is first part of the option is also wrong. Second part of the option is also wrong. Look at option C. Decrease total asset and net income. First, in this option, in option C also net income is there. So again, this entry is not going to have any impact on the P&L statement. So decreasing net income, that is not a right answer. So option C cannot be the right answer. Look at option D. Have no effect on total assets and decrease net income. Again, here option D says this entry will decrease the net income, but again it is going to affect only the asset side of the balance sheet. So option D cannot be the right answer. Now look at option A. Option A is obviously right. Have no effect on total asset and net income. By now you would have understood why this entry is not going to have any impact on net income. Why? Because this entry is not going to have any impact on net income, because this entry is going to affect only the only the asset side of the balance sheet. Accounts receivable is an asset account. Provision for doubtful debt is a contra asset account. So it is going to affect only the asset side of the balance sheet. So net income will not be affected. How how it will have no impact on total asset of the company? This entry is going to have no impact on total asset of the company. How? Listen. Before making this entry, what is the accounts receivable of the company? 7,50,000. What is the provision for doubtful debts? We already have 16,500. So from 7,50,000, we will subtract 16,500. So the net realizable amount is 7,50,000 minus 16,500. We get 7,33,500. What does it mean? It means that our total receivable is 7,50,000, out of which we are expecting that a customer's worth of 16,500 will not pay. So the net realizable amount is only 7,33,500. Now, what is going to be the effect of this entry on the asset side of the balance sheet? Listen, we have credited accounts receivable. So by 10,000 rupees, accounts receivable should decrease, right? So after passing this entry, accounts receivable will reduce to 7,40,000. We have debited provision for doubtful debts. So if you are debiting provision for doubtful debts, it means we are decreasing the balance in the provision for doubtful debts account. If you are crediting provision for doubtful debts, it means you are increasing the provision for doubtful debts balance account. So here provision for doubtful debts is debited by how many rupees? 10,000 rupees. So we already had 16,000 as the balance. Sorry, we already had 16,500 as the balance, out of which 10,000 is reduced. So what is the closing balance of provision for doubtful debts? It is only 6,500. So what is the net impact? Again, 7,40,000 minus 6,500. We get same 7,33,500. So even after passing this journal entry, the total of the asset side is not going to be impacted. So this entry will not have any impact on the net income, and it will not have any impact on the total asset of the company. So option A is the right answer. So what is important to understand is the journal entry for estimating bad debt will impact your net income. What I am trying to say is, for example, let's look at question number 4. With this I will explain which entry will impact the P&L. As a result of the 30th November, so this question should also be answered from this information given. As a result of 30th November adjusting entry to provide credit losses, the credit balance in the allowance for credit loss account will increase by how many rupees or decrease by how many rupees? That is what we need to calculate. Listen, the question clearly says Madison evaluation indicates that 1.5% of credit sales will be credit losses. What is the credit sale of the company? Total credit sales is 18 lakh, out of which we gave a discount of 1,25,000 and 1,75,000 as a sales return. So net credit sales is only 15 lakh, on which we are expecting 1.5% will be bad debt. So what is 1.5% of 15 lakh? We get 22,500. So what is the journal entry that we have to pass for this? We will debit bad debt expense. Bad debt expense is nothing but it will go to P&L. So we will debit bad debt expenses. How many rupees? 22,500. What we should credit? We should credit provision for doubtful debts. Sorry, we should credit provision for doubtful debts. How many rupees? 22,500. So here what is happening? We are, while estimating the bad debt losses, P&L is affected. While estimating the bad debt losses, P&L, this 22,500 will be debited to P&L. So in that case, what will happen? Net income will reduce because expense side of your P&L is increasing, right? So while estimating the credit, while estimating the bad debt losses only, or while pausing the entry for estimation of bad debt losses only, will impact your net income. The journal entry for write-off of bad debt will not have any impact on your net income. So what is the answer? Here provision for doubtful debts is increasing by how many rupees? 22,500. So as a result of the 30th November adjusting entry, this is the adjusting entry. As a result of the adjusting entry to provide for credit losses, the credit balance in allowance for credit loss account will increase by how many rupees? It will increase by 22,500 rupees. It will increase by 22,500, which is nothing but 1.5% of 15 lakh. Now let me change the question. It will increase, instead of by, let's replace it to, it will increase to how many rupees? None of these options will be there. It will increase to how many rupees? We already have how much? 6,500. On top of the 6,500, we are adding another 22,500. So totally it will increase to 22,500 plus 6,500. It will increase to 29,000. So this 29,000 is nothing but the closing balance of the provision for doubtful debts account. I hope it is clear. So question number 5, 6, 7. It is based on the same fact pattern from here till here. In question number 5, 6, 7 we have. Bright Corporation formerly estimated its credit loss expense as 1.5% of credit sales. It now uses current expected credit loss model to estimate credit loss expense using an accounts receivable aging analysis along with other relevant information. What they are saying is, right now, Bright Corporation is estimating its bad debt expense as a percentage of credit sales. But now they want to estimate their credit loss expense using the accounts receivable figure rather than credit sales figure. The aging schedule of Bright's accounts receivable, Brighton's accounts receivable at 30th November 2014, with estimated probabilities of collection for each aging group based upon past collection experience, information about current condition, reasonable and supportable forecast that affect the collectability of outstanding balance is presented as follows. What they are saying is, the total accounts receivable balance of the company is 9,55,000. This is the total accounts receivable balance. Out of this 9,55,000, 6,40,000 worth of customers, 6,40,000 worth of customers did not pay for 30 days, and there is a 98% probability that they will pay the money. Why? Because they have just purchased recently, just 30 days before, and during this 30 days they did not pay the money. So 6,40,000 worth of customers did not pay the money for 30 days. So the probability of collection from them is high. If probability of collection is 98%, then what is the probability of not collecting money from them? It is 0.2. Which means out of the 6,40,000 rupees, you are expecting that 2% of the customers will not pay the money. Then 1,80,000 rupees of, or 1,80,000 rupees worth of customers did not pay the money for 31 days to 60 days, and probability of collecting money from them reduces from 98 to 92. So if probability of collecting the money from them is 92%, then you are expecting that 8% of customers in this range will not pay the money. Similarly, customers who purchased goods worth of 95,000 did not pay the money for 61 to 90 days. Probability reduces further to 75%. So probability of not collecting money from them is 25%. Customers worth of 40,000 rupees did not pay money over a period of 90 days. So probability of collecting money from them reduces to 60%. So probability of not collecting money from them is 40%. Now what we have to do is we have to calculate the expected amount of credit loss. How to calculate it? We have to calculate the expected, right? Expected figure, right? We have the probabilities over here. So how do we calculate the expected figure? It is nothing but the weighted average mean. What is the weighted average mean? Just multiply 6,40,000 with 2% and 1,80,000 with 8%, 95,000 with 25%, 40,000 with 40% and add everything. Whatever we get is nothing but the expected amount. So 6,40,000 into 2% we get 12,800 plus 1,80,000 into 0.08 we get 14,400 plus 95,000 into 0.25 we get 23,750. In 40,000 into 0.4 we get plus 40,000 to 0.4 we get 16,000. So when we add everything, how much do we get? 16,000 plus 23,750 plus 14,400 plus 12,800 we get 66,950 rupees. What does it mean? Out of the total receivables of 9,55,000, 66,950 is the, you are expecting that customers out of 66,950 will not pay the money. But this 66,950, is this your credit loss expense? No, this is not your credit loss expense. This is the closing balance of the provision for doubtful debts. Why? Because this accounts receivable is a balance sheet figure. Right? This is a closing balance sheet figure. So this figure which we calculated from the accounts receivable should be the closing balance of the provision for doubtful debts. Right? The total sales for the fiscal year were 65 lakh, of which 85% were on credit. The allowance for credit losses account had a credit balance of 76,500 on 1st January 2013. So this is the balance, this is the opening balance for this year, which is nothing but the closing balance of the previous year. At the beginning of the year, we had 76,500, that is on 1st December 2013. So December 1, 2013, we had a balance of 76,500 and a debit balance of $3,400 on 30th November 2014. So exactly 1 year from this date, at the end of the year, that is November 30, 2014, we are having 3,400 rupees of debit balance. See, if you are having a credit balance on provision for doubtful debts, it is a positive figure. But if you are having a debit balance on provision for doubtful debts, it is a negative figure. Before any entry to record credit loss expense for the fiscal year 2013-14. What does it mean? It means that before increasing the value of provision for doubtful debts, which means before passing this entry, which entry? Debit bad debt expense, credit provision for doubtful debts. Before passing this entry, we have a debit balance of 3,400. I hope it is clear. Now, before looking at the requirement of the question, let's do some, let's understand this question. What is the opening balance we had? 76,500. In which account? In provision for doubtful debts account. It is a credit balance, which means it is a positive figure. What is the closing balance we have in provision for doubtful debts account? 3,400. It is a debit balance, which means it is a negative figure. So, on 1st December 2013, we had 76,500 positive. This positive 76,500 has reduced to negative 3,400 over a period of 1 year. What does it mean? It means that first the 76,500 reduced to 0. Then from 0 again it reduced by another 3,400 rupees. So it reached negative 3,400. Now how it became a negative balance of 3,400? What happened in between? That is what we need to understand. First, when provision for doubtful debt account will reduce. Here provision for doubtful debt account has reduced from 76,500 positive to 3,400 negative. Generally, when provision for doubtful debt account will decrease? When accounts are written off. What is the journal entry for write-off? Debit, provision for doubtful debts. Credit, accounts receivable. So by some X amount, we don't know how much rupees, but by some X amount, we reduced the provision for doubtful debts. So it reduced from 76,500 positive to 3,400 negative. So by how many rupees you would have reduced your provision for doubtful debts so that it reduced from 76,500 positive to 3,400 negative? From 76,500 it reduced to 0. So there is a decrease of how many rupees? 76,500 rupees decreased. Did it stop at 0? No. The balance went to negative 3,400. So from 0 again it reduced to another 3,400 rupees. So totally by how many rupees the provision for doubtful debt account reduced? It reduced by 76,500 plus 3,400. So what is the total decrease in the value of provision for doubtful debt? 76,500 plus 3,400. We get 79,900, which means from 76,500 it reduced by 79,900 rupees so that it became negative 3,400. Now what is this 79,900? The 79,900 is nothing but the amount of bad debt that is written off during this period. When I say written off, the 79,500 is not estimated. Customers who purchased goods from you worth of 79,900 rupees went bankrupt. They are not going to pay. It is irrecoverable. So the 79,900 is written off. So what is the journal entry? Debit provision for doubtful debts by 79,900 and credit accounts receivable 79,900. So from 76,500 positive, it was reduced by 79,900 rupees. So the provision for doubtful debt became 3,400 negative. I hope it is clear so far. Then what happened? Listen, this 3,400 is before any entry to record credit loss expense for the year. Correct? Before making any adjustment entry at the end of the year, the balance is 3,400 negative. But obviously we will make some adjustment entry at the end of the year. What is that adjustment entry and how it is going to impact? Listen, we know that the closing balance of provision for doubtful debt should be how much? 66,950. On which date? On 30th November 2014, the value of on 30th November 2014, the closing balance of provision for doubtful debts should be 66,950 rupees. Right, but what is the actual closing balance we have on 30th November 2014? It is only 3,400 negative. But what is the closing balance we should have on 30th November 2014? We should have 66,950 rupees. But we have only 3,400. So what we should do? We should increase the value of the provision for doubtful debts. That is the adjusting entry we have to pass. Right. So what will be the adjusting entry? The adjusting entry will be debit provision for provision for doubtful debts should be increased. Right. So credit provision for doubtful debts. Then we have to debit what? Debit bad debt expense account. Bad debt expense account. This is nothing but the P&L. Right. So we should have 66,950 at the end of the year, but we have only 3,400. So first what we should do, this 3,400 from negative 3,400, it should be increased to 0. Right? Then from 0 it should increase to 66,950. So totally by how many rupees we should increase this 3,400 so that this so that the closing balance will become 66,950. That is what we need to calculate. So first, from negative 3,400 we should increase it to 0. So there will be a 3,400 rupees increase. Then from 0 we should increase to 66,950. So 66,950 increase. So 3,400 increase plus 66,950 increase. So what is the total? 66,950 plus 3,400 we get. Totally we have to increase by 70,350 rupees. So to the P&L account we should debit 70,350 and provision for doubtful debt should be credited by 70,350. So the credit loss expense for the period is 70,350 rupees. Right, and the closing balance on provision for doubtful debt should be 66,950 rupees. And the bad debt that is written off during the period is 79,900 rupees. I hope it is clear. Now look at the fifth question. Using CECL model. CECL model is nothing but the current expected credit loss model. Using CECL model, the information in the aging schedule, using CECL model and the information in the aging schedule, Brighton's credit loss expense for the fiscal year 2013-14 should be how much? So what is the credit loss they should expense? Sorry, what is the amount of credit loss they should expense to their P&L account? It is 70,350 rupees. That is what we saw right now. So option C is the right answer. 70,350 rupees. Look at question number 6. Using the CECL model and the information in the aging schedule, the balance in the allowance for credit loss account after adjusting entries made on 30th November 2014 will be how much? They are asking us to calculate the closing balance. In which account? In provision for doubtful debts account. After making the adjustment entry. So before making the adjustment entry, the balance is 3,400. After making the adjustment entry, what should be the closing balance? It should become 66,950. So option C is the right answer. 66,950. The value of accounts receivable written off by Brighton Corporation during the year 2013-14 fiscal year is how much? What is the amount of bad debt that is written off? It is 79,900 rupees. This is what we calculated over here. During the period, the opening balance was 76,500, but customers worth of 79,900 did not pay the money. We expected only 76,500, but actual loss is more than what we expected. That is the reason why provision for doubtful debt became negative 3,400. So 79,900 is the amount of bad debt that is written off during the period.